Should you be contributing to Roth accounts or traditional accounts for your retirement? This is an important question whether you are at the beginning of your journey or in the final few years before you retire. Which account puts you in the best spot? The answer may surprise you. Now, right off the front end here, please forgive my congestion in this video. I'm coming off one of those awesome late summer colds and finally just kicking it, but apparently my voice is taking a little bit of time to come back. Anyway, let's start by broadly laying out the landscape and look at the options we have for deciding how to contribute to retirement and how these choices can have big implications. First, we have the Roth account, often referred to as a tax-free account. You have two options here, a regular Roth IRA, or you can contribute to a Roth 401k if your employer offers this option. Now, I don't really love referring to this as a tax-free account because you still do pay taxes when you contribute to this account. You just pay the taxes up front on the contribution and then are never taxed again on this account. Next, we have an account we will mainly be comparing to in this video, the traditional account, otherwise known as tax-deferred accounts. There are a few more accounts that fit into this category, such as a traditional IRA, traditional 401k or 403b, or thrift savings plan, and you also have your SEP and simple IRAs here as well. With these accounts, you receive a tax break up front on your contribution. You then grow this money tax deferred and eventually owe taxes when you decide to withdraw the monies in this account. Thus the name tax deferred. Keep in mind, the IRS will not allow deferral indefinitely. So in your 70s, they will start mandating that you take money from these accounts, whether you want to or not. Now, in this video, we're going to focus on whether it makes sense for you to contribute to one of these accounts versus contributing to the other. But in this process, we can take the insights from this decision and actually draw a straight line to other decisions in retirement planning, such as Roth conversions. Effectively, a Roth conversion from a tax standpoint is essentially tax equivalent to a Roth contribution. You are taking money from your traditional account, paying tax on it today, then converting it to Roth. So just keep this in mind as we are walking through examples together. Then just to close the loop on this discussion, you also have the ability to save retirement dollars into a taxable account as a third option. For the sake of narrowing the scope of this conversation and keeping it a more manageable video, I'm going to stick to just comparing traditional and Roth accounts, but plan to compare retirement accounts to taxable accounts at some point in the future. Let me know in the comments below if you'd like to see that comparison. Okay, now here's what I find all too often from both the average person and professionals alike. They tend to fall in love with one specific account type and stick to that account like it's a religion. For instance, I've met CPAs that always recommend you contribute to tax-deferred accounts. They are used to being judged based on keeping a given year's tax liability low, and so recommend deferral as much as possible because of that tax break and tax lowering today. The problem is the government doesn't allow you to endlessly defer taxes. I've met others who swear you should always contribute to Roth. After all, growing money tax-free and being able to withdraw tax-free in retirement seems like a no-brainer win-win. Now, both of these stances are wrong because neither account has inherent benefits over the other, even though it might seem like one does. Let me explain with a simplified mathematical proof. I'm going to explain this using a Roth conversion versus no Roth conversion scenario, but as I explained earlier, this creates a tax equivalent scenario to comparing contributions into either account. The reason I'm using a Roth conversion in this proof is that it saves us some time and added complexity of adding in contributions. And again, keep in mind, you could also change this up where you could look at the $100,000 versus $85,000 amounts we're comparing to as the amount that would have been contributed up to as well. So we don't have to look at it completely in a conversion type of scenario here. What we will find is that neither account, again, has any inherent benefit. It's all going to come down to the tax rate you pay on both contribution and withdrawal if we equalize out performance. For the sake of this discussion, let's say someone pays a flat rate of 15% on contributions or on conversions and 15% also on withdrawals. If performance is the same in both situations, which it is in this example at 7% per year, then we will see a tax-deferred contributor will end up with a bigger asset value in their traditional account before withdrawals. Keep in mind, however, this is a vanity metric. It's like comparing your gross pay to your net pay. Sure, gross pay is always going to be larger, but it's meaningless because you can't spend your gross pay at the grocery store. You spend your net pay. To equalize out these situations, we need to withdraw money from these accounts. And because we owe taxes on withdrawals in the traditional account situation, we're going to be forced to withdraw more as shown on the screen. Ultimately, paying a constant 15% rate in both cases gives you the exact same wealth situation. We can even take this situation and make it slightly more complex and use actual portfolio returns. After all, no portfolio grows by just a steady 7% per year. So let's use stock returns from 2004 to 2022. Even though we introduce sequence of return risk here, the result does not change. We end up in the exact same situation if we pay the exact same rates. So projecting out this finding is fairly simple. When we are in low tax brackets, either because we've changed jobs or are at the beginning of our working career or have some other major life change, we should probably look to contribute to our Roth accounts as we will probably be paying fairly low tax rates. On the other hand, when we are in very high tax brackets, paying high tax rates, maybe because of a high paying job, we should prefer deferring taxes into the future to some lower tax paying opportunity. The right answer is always going to be relative to your situation. But here's a general guide for most people. Emphasis here on general. On the screen, we have the 7 current tax rate buckets shown. If you find yourself in the 10% and 12% bracket, specifically while working, most people should contribute to Roth. Based on the current tax brackets, the only time this wouldn't make sense is if you find yourself in retirement not even able to fill up a standard deduction and essentially pay a 0% tax rate. In that unlikely scenario, you would have paid a 10 or 12% tax rate to get money into a Roth to avoid paying a 0% tax rate on withdrawal, which wouldn't make sense from a pure quantitative standpoint, but is highly unlikely for many savers. Then on the other side of the spectrum, if you find yourself in the 35 or 37% brackets, this should be an easy tax deferral decision. The likelihood that you withdraw money in retirement at a tax rate greater than 37% is quite small unless we are betting really heavily on taxes going up, which we'll talk about in this video. Keep in mind as well, here in America, we have a progressive tax system where you are taxed at 10%, 12%, 22%, and so on until you have enough taxable income to push you into that 37% bracket. So there are a lot of low tax rate buckets to fill in retirement before seeing that 37% bracket, thus making deferral make a lot more sense. Now, the middle zones of 22% to 32% are a bit more of a contextual decision. Initially, most people think they're going to be in a lower tax bracket in retirement, never seeing anything beyond a 22% bracket at most. But the more you learn about retirement taxes, the more you realize things are much more complex than this. There are many workers and retirees right now who are benefiting at converting and contributing in the 22% and 24% brackets. But again, it depends. Here's one consideration. Right now, we're in a tax regime that is set to expire at the end of 2025. The current rates you see on the right are set to revert to the old rates that you see on the left. Now again, if we're comparing rates versus rates, some investors are finding it beneficial to take advantage of the 22 and 24% rates right now to avoid paying 25% post-2025. Based on the math we walked through earlier, this makes sense. Lower rates equals tax savings. But in addition to that, tax brackets become much more complex in retirement. Let's take something like Social Security. The amount of your Social Security benefit that will be subject to tax is determined by your other taxable income. Said differently, withdrawing from traditional IRAs will increase Social Security taxability, where withdrawing from Roth will not affect Social Security taxability. This creates a tax trap called the Social Security tax torpedo. Now, I'm going to gloss over how this tax hurdle is created, but you can find a full explanation in this video right here. Once a retiree is on Social Security, they will effectively never pay 10% and 12% tax rates again because of the increased rates due to the Social Security tax torpedo. The 10% bracket turns into 15 or 18.5, and the 12% bracket turns into 22.2%. Then for a short period of time, even the 22% bracket can turn into 40.7%. Again, these are based on current rates. Again, what is happening in the background is there's essentially a double taxation effect where you pulling money from your traditional IRAs makes your Social Security benefit taxable. One taxable event creates two tax effects, basically. Now, this tax hurdle completely defeats the idea that you're going to be able to withdraw a bunch of money in retirement at 10 and 12% rates. The reality is those rates will be much higher. But then why does everyone say taxes fall in retirement? Well, there is some partial truth to this idea. Your effective tax rate will go down because certain accounts are less taxed, thus artificially lowering your effective tax rate. Again, your effective tax rate is the taxes you paid divided by the total income that you could withdraw. So if only part of that income is taxed, then that's going to artificially lower that effective tax rate. But your marginal tax rate, the one that matters here for contribution and conversion decision, often rises. It might seem confusing, but both of these things can be true at the same time. So again, generally speaking, you should make the bulk of your contribution decisions based on tax rates today versus expected tax rates in the future. Almost everyone will benefit from having some portion of both Roth and traditional funds, but the proportions should vary based on your specific situation. But there are other factors to consider here. One is the life cycle of your career. If your household has some big income variations in tax rates through time, because maybe you're in an incentive-based job or you own your own business, then you should effectively be playing the tax tables each and every year to your advantage. This graphic from Kitseys.com illustrates this idea perfectly as it takes you through the life cycle of a hypothetical business owner. During low earning years or years when only one spouse worked, tax rates are low and Roth is probably preferred in this situation. During years of high income or a period where big assets like the business are sold off, deferral is the clear winner. If we project out optimized decisions around these tax rates versus a naive approach of just contributing equally to both types of accounts, we can see the benefit of long-term optimization. The optimization results in a 15% difference in after-tax wealth by the time this couple is 75, which is a massive difference in dollarized terms. Other jobs may have more steady income, but a lot of career advancement, and they will find the best strategy generally to contribute to Roth when young and then deferring when older, as, again, the decision that makes the most sense. Career progression here is a big factor. Another factor I hear brought up frequently is the impact of future tax hikes on this discussion. I don't need to tell most of you how bad the national debt is becoming. We are currently up to $35 trillion, which means we could wipe out the debt if each individual here in the US made a low one-time payment of just $105,000. That's it. Then poof, the debt is completely gone. Gosh, did this video take a depressing turn. Anyway, this growing national debt leads some to think it's almost certain that taxes need to go up in the future to deal with this debt. And it does appear that way on the surface. But the tough thing is, predicting future tax rates is nearly impossible. The debt as we know it today really started to take off in the early 80s when compared to GDP, and only saw a brief reprieve during the late 90s. Throughout this time, effective tax rates across taxpayers stayed quite even. Now, one could argue this has perpetuated the debt. But if we had tax problems before and taxes have stayed quite consistent, what's to say that won't continue to be the case? For instance, steady tax rates going forward in the future will likely perpetuate more debt until there are more dire reasons to focus on this debt problem. So the first issue with the idea that taxes may go up is essentially timing. For the older audience watching this video, there's no guarantee it happens in your life. Second, taxes can go up in a lot of different ways. They can go up across the board with all brackets rising a few percent. They can also go up for just a subset of taxpayers, like the rich or corporations. These changes may not even affect your situation. Most people see the debt and see one tax possibility, when in fact there are near infinite possibilities. Now, this video focused on the contribution side of the equation and hopefully shed some light on which contribution strategy is best for your situation. As you get into retirement, the opposite side of the coin is how to optimize the order you withdraw from your accounts. And here's a video that talks about which account you should withdraw from first. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching, and we'll see you in the next video.